People ask me what made Warren Buffett different. They want his secret stock-picking method or special formula. I tell them he did one thing for 60 years that nobody else had the discipline to do. They look confused. They want something complex. I'm 99 years old. I've sat across from Warren in meetings for 6 decades. I've watched him build $140 billion from a newspaper route, and I'm telling you, what made him different wasn't intelligence. Plenty of people are smarter than Warren. It wasn't access. We all had access to the same investments. It was one behavior he repeated for 60 years without deviation. This isn't theory. This is observation. I watched it happen year after year, decade after decade, while everyone else was doing something different. And that's why you've heard of Warren Buffett and not them. Hit the like button if you're ready to understand what actually separates billionaires from everyone else. I only share this with people who think in decades, not quarters. Before we get into this, do me a favor, drop a comment right now and tell me where you're watching from. I want to know who's here. City, state, country. Just let me know. Here's why smart people stay ordinary. Most people think success in investing comes from finding better opportunities than everyone else. That's nonsense. Warren didn't get richer because he found better deals. He got richer because he did one thing consistently that everyone else abandoned the moment it got uncomfortable. You don't need to be brilliant. You don't need an MBA. You don't need connections. You just need to do what Warren did. And keep doing it when everyone around you thinks you're stupid for not changing. I'll show you the 5 simple rules that explain the one behavior Warren mastered. Rules that made him the greatest investor alive. Rules that anyone can follow, but almost nobody will. The first rule is the hardest because it requires you to look stupid for years at a time. Let's start. Rule number 1. Only swing at pitches. You understand the one thing Warren did for 60 years that nobody else does? He said no. Over and over and over. He said no to almost everything. That sounds stupid. How do you get rich by saying no? Here's how. By only saying yes to things you completely understand. Here's the problem with most investors. They feel pressure to swing at every pitch. New technology? They need to invest. Hot IPO? They need to get in. Everyone's making money in crypto? They can't miss out. They swing at everything because sitting still feels like falling behind. Warren sat still for decades. Let me tell you about the dot-com bubble, 1999 to early 2000. Everyone was getting rich in technology stocks. Pets.com, eToys, Webvan, companies losing money, but stocks kept going up. Fund managers were making 100% returns in months. They felt brilliant. Warren bought nothing, not one tech stock. People called him washed up. Buffett doesn't understand the new economy, they said. Forbes questioned if he'd lost his touch. His fund was down 20% that year, while tech funds were up 100%. He looked stupid. Then 2001 happened. Pets.com went from $11 to bankruptcy in 268 days. eToys went from 86 to 0 by 09. Those brilliant fund managers lost everything they'd gained plus their original capital. Warren, he lost nothing because he never played a game he didn't understand. Here's the specific case that proves this. 1999. James Cramer was running a hedge fund. Very smart guy. Huge returns in tech stocks. He went on TV and said Warren Buffett was done and his methodology was over. By 2000, Cramer's fund had returned over 150% on tech. Warren's Berkshire was flat. Cramer looked like a genius. Then 2001. Cramer's fund lost 68% of its value. Many of his tech stocks went to zero. He shut down the fund in 2001. Warren? Berkshire was up. 20 years later, Berkshire stock is up 800% from 2000. Kramer's fund doesn't exist. Here's the math. $100,000 invested in what you understand at 10% becomes $930,000 in 20 years. Boring, slow, but real. $100,000 in things you don't understand? You might make 100% year one, then lose 80% year two. You're at $40,000, you never recover. I'll give you another example that drives this home. 2017, a doctor in Boston, smart guy, cardiologist, made $480,000 a year. He understood medicine, he understood the human heart. But his neighbor worked at a crypto startup and kept talking about blockchain. The neighbor was 28 years old, driving a new Tesla, talking about his Bitcoin gains. The doctor felt left behind. So he took $200,000, money he'd saved over 5 years, and bought Bitcoin at $18,000 per coin. Then Ethereum. Then 3 other coins his neighbor recommended. By December 2017, Bitcoin hit $19,000. His $200,000 was worth $210,000. He felt smart. Then January 2018 happened. Bitcoin crashed to $6,000. His other coins crashed 90%. By the end of 2018, his $200,000 was worth $41,000. He panicked and sold, lost $159,000. Why? Because he invested in something he didn't understand just because his neighbor was making money. Meanwhile, his colleague, another cardiologist at the same hospital, took that same $200,000 and bought shares in medical device companies. Johnson & Johnson, Medtronic, Stryker. Companies he understood because he used their products every day. He knew their margins. He knew their competitive advantages. He knew which devices surgeons preferred and why. Over that same period, his $200,000 grew to $287,000, not as exciting as Bitcoin's peak, but he kept his gains. By 2023, that $200,000 had become $425,000. The first doctor, still trying to recover from his crypto losses. Compare that to a Coca-Cola factory supervisor in Atlanta, made $55,000 a year in the 1980s. He understood Coca-Cola intimately, knew they made 40% margins on syrup, knew they had pricing power, knew the moat was real. He put every extra dollar into Coca-Cola stock. Just Coca-Cola, nothing else. People told him to diversify. He said, "Why would I buy businesses I don't understand when I understand this one perfectly?" He retired in 2005 with $3.8 million from a $55,000 a year salary because he only swung at the one pitch he completely understood. That's what Warren did for 60 years. He only invested in businesses he could explain to a 5-year-old. If he couldn't, he didn't invest. That discipline, that willingness to say no to everything else, is what nobody else does. Here's what most people miss. Warren passed on Google, passed on Amazon for years, passed on Microsoft in its early days. Were those mistakes? Maybe. But here's what matters. He never lost money on businesses he didn't understand, and that discipline saved him from 1,000 disasters that would have wiped out his capital. Think about it. If you avoid losing money on things you don't understand, you preserve capital for things you do understand. Most investors do the opposite. They lose money on dozens of investments they didn't understand, then have no capital left when opportunities they actually understand come along. I saw this happen to a venture capitalist in Silicon Valley. 2005. He'd made $40 million investing in software companies. Then he decided to invest in biotech because that's where the future is. Put $15 million into 3 biotech startups, sophisticated pitch decks, smart-sounding scientists, impressive lab equipment. He didn't understand biology, didn't understand FDA approval processes, didn't understand clinical trials. But everyone was making money in biotech, so he jumped in. All 3 companies failed. Every penny gone. $15 million vanished. If he'd stuck to software, businesses he actually understood, that $15 million could have grown to $60 million over the next decade. Instead, he spent 5 years trying to rebuild capital he never should have risked. Warren never made that mistake. He stayed within what he called his circle of competence. If a business fell outside that circle, he didn't care how good the opportunity looked. He said no. But understanding isn't enough. You need something else. Stop right now. Think about your last 3 investments. Could you have explained to a child exactly how those businesses make money? If not, you weren't investing. You were gambling. Rule for 2. Only buy when the price is stupid. Once Warren understood a business, he still didn't buy it. He waited. He waited for the price to be so low that it was stupid not to buy. Here's the second problem. Most investors find a good business and immediately buy it. They think finding the business is the hard part. Warren knew that finding good businesses is easy. Buying them at the right price is hard. Let me tell you about American Express in 1963. The salad oil scandal. Anthony DeAngelis had been using American Express warehouse receipts as collateral for loans. His warehouses were full of water, not salad oil. Massive fraud. When discovered, American Express stock crashed 50%. Everyone panicked. American Express will be sued into bankruptcy, they said. Warren studied it, went to restaurants and stores, asked people about their American Express cards. Nobody cared about the salad oil scandal. They still wanted their cards. He realized the brand was intact. The traveler's checks business was intact. The charge card business was intact. The actual value of the business hadn't changed. Only the stock price had. He bought 5% of the entire company at $35 per share, $13 million, 40% of Berkshire's entire portfolio. Massive bet. 5 years later, American Express was at $180. That $13 million became $67 million today. Berkshire's American Express stake is worth over $22 billion because Warren waited for the price to be stupid before buying a business he understood. I remember that day. We were sitting in his office in Omaha. He showed me the numbers. "Charlie," he said, "the business is worth $100, but I can buy it for $35. That's not analysis. That's arithmetic." Most people couldn't pull the trigger. The newspapers were saying American Express was finished. The stock had been cut in half. It felt dangerous. Warren saw it differently. The danger wasn't in buying at $35. The danger was in missing the opportunity. Contrast that with Amazon. Great company, incredible business. But people bought it at $100 in 1999 because it was great. Then it crashed to $6 by 2001. Those who bought at $100 lost 94%, even though they were right about it being a great business. They just paid the wrong price. The investors who made money on Amazon waited for 2001 when the price was $6 and the business was actually better than 1999. Same business, different discipline. Here's a surgeon in Chicago. 2007, he understood real estate, bought 3 properties at the peak for $320,000 each. Good properties, would rent for $2,000 a month. But at $320,000, the numbers barely worked. He needed those properties to appreciate just to break even on his financing costs. 2009, those properties dropped to $140,000 each. He was underwater. Eventually sold 2 at $160,000 each in 2011. Lost over $300,000 total because he bought good properties at stupid prices. Meanwhile, a plumber in Phoenix. 2009. He'd been saving cash and waiting. Everyone told him to buy in 2006. Real estate only goes up, they said. He kept saving, kept waiting. When the market crashed, he bought 3 properties for $95,000 each. Total, $285,000. Same properties the surgeon bought for $320,000 by 2015, worth $240,000 each. By 2020, $380,000 each. Today, $460,000 each. His $285,000 is now $138 million. The surgeon lost $300,000. The plumber made $1.1 million. Same market, same properties, different entry price. Here's what kills me. The surgeon was smarter, better education, higher income. But the plumber had discipline. He waited for the stupid price. The surgeon didn't. Intelligence doesn't beat discipline. Here's the math that changes everything. You buy a business worth $100 for $100. It grows 10% a year. In 20 years, you have $672. You made 6.7x your money. You buy that same business for $50 when everyone's panicking. It still grows 10% a year. In 20 years, you still have 670 toes, but you only paid $50. You made 13.4x your money. Same business, same growth. You doubled your returns by waiting for the stupid price. Warren did this over and over. Washington Post in 1973, Coca-Cola in 1988, Goldman Sachs in 2008. Every time he waited for the price to be so low, it was stupid not to buy. Let me tell you about 2008. The financial crisis, banks were collapsing. Everyone was terrified. Goldman Sachs needed capital. Warren gave them $5 billion, but not as a regular investment. He negotiated preferred shares paying 10% annually, plus warrants to buy common stock at $115. People thought he was crazy. Goldman might fail, they said. Warren saw it differently. Goldman was trading at $125, but the warrants let him buy at $115s, and he was getting paid 10% a year to wait. If Goldman survived, which he believed it would, he'd make a fortune. If it didn't, his preferred shares had priority. Goldman survived. Those warrants became worth $3.7 billion. Plus, he collected $500 million a year in dividends. He turned $5 billion into over $8 billion in 5 years because he waited for a crisis to get a stupid price. That's the discipline nobody else has. They find a good business and buy immediately. Warren finds a good business and waits, sometimes years, for the stupid price. But you can destroy this entire strategy with one thing. Rule number 3, never sell just because the price went up. Once Warren bought at the stupid price, he held and held and held for decades. He never sold just because the stock price doubled or tripled. Here's the third problem, and it's the biggest. People cannot resist taking profits. They buy a stock at $50. It goes to $100. They sell. I doubled my money. They feel smart. They just destroyed their compounding. Let me tell you what Warren did with Coca-Cola. He bought it in 1988 for $1.02 billion. By 1993, worth $3 billion. By 1998, worth $13 billion. People kept asking, Warren, aren't you going to sell Coca-Cola? You're up 1,200%. He said, why would I sell my best business? Today, that position is worth over $25 billion. Plus, Berkshire has received over $8 billion in dividends over 36 years. If he'd sold in 1998 when he was up 1,200%, he would have walked away with $13 billion. By holding, he got $33 billion. He made an extra $20 billion by not selling. But that's not even the full story. Because Warren never sold Coca-Cola, he never paid capital gains taxes on the appreciation. That money kept compounding tax-free for 36 years. If he'd sold and paid 20% capital gains, he would have given the government $2.4 billion in 1998. That $2.4 billion, if it had stayed in Coca-Cola, would be worth over $6 billion today. Compare that to a lawyer in San Francisco. 1990, bought Microsoft at $0.60 per share, invested $50,000, got $83,000 shares. By 1995, Microsoft was at $180. He was up 200%. He sold, took his $150,000, felt brilliant. I tripled my money in 5 years. Today, Microsoft trades at $370 per share. His 83,000 shares would be worth $30.7 million. By selling to lock in profits, He gave up $30.5 million. He made $100,000. He could have made $30.6 million. Same starting point, different discipline. Here's what kills most people. They sell winners too early and hold losers too long. It's backward. Warren did the opposite. He held his winners forever and sold his losers quickly. Washington Post, bought in 1973 for $10.6 million. By 1985, worth $140 million. People said, sell. He held. By 2000, worth $1.7 billion. People said, now sell. He held. He held Washington Post for 40 years, never sold a share. Eventually sold to Jeff Bezos in 2013. His $10.6 million investment returned over $1.2 billion total because he never sold just because the price went up. Here's the math. $100,000 in a great business compounding at 15% annually. Hold for 40 years, you have $26.7 million. Sell after 10 years because you doubled your money. You have $404,000. Invest that $404,000 at 10% for 30 more years. You end up with $7 million. You gave up $19.7 million by selling your best business early. Most people cannot do this. They cannot watch a stock triple and not sell. Warren understood that the real money is made by never selling your best businesses. I'll tell you about another case. An accountant in Seattle. 1997. He bought Starbucks at $3 per share, put in $25,000, got roughly 8,300 shares. By 2000, Starbucks hit $15. His $25,000 was now $125,000. His friends told him to sell. You quintupled your money, take it. He almost sold, came very close. But then he thought about Warren's approach. He asked himself, has the business gotten worse? No. Do I still understand it? Yes. Is it still growing? Yes. So he held. By 2006, Starbucks was at $36. His position was worth $300,000. Friend said, now you definitely need to sell. He didn't. By 2021, accounting for splits, his position was worth over $900,000, from $25,000 to $900,000, because he never sold just because the price went up. His neighbor did the opposite. Bought Starbucks the same year, same price. Sold in 2000 at $15, made $100,000. Felt smart. Then spent the next 20 years watching Starbucks go higher and higher while his $100,000 sat in bonds earning 4%. His $100,000 became $220,000. The accountant's $25,000 became $900,000. Here's what Warren understood that most people don't. Your best investments will make you uncomfortable. They'll go up so much that selling feels responsible, but that's exactly when you need to hold. There's a psychological trap here. When you buy a stock at $50 and it goes to $150, your brain starts screaming at you. Take the profit. What if it crashes? You'll feel stupid. That voice gets louder every day the stock goes higher. But Warren trained himself to ask different questions. Not, how much have I made? But, would I buy more of this business today at this price? If the answer was yes, he held. If the answer was no, he considered selling. Most people ask the wrong question. They ask, should I lock in this gain? Warren asked, is this still one of my best businesses? Completely different framework. I'll tell you about a furniture store owner in Nebraska. Friend of Warren's, 1985. She bought stock in a company she understood, Nebraska Furniture Mart. By 1995, her shares had tripled. Everyone told her to sell. You're up 200%. Take it. She asked Warren what to do. He said, is it a better business now than when you bought it? She thought about it. Actually, yes. They've expanded. Margins are better. Competition is weaker. Warren said, then why would you sell? She held for another 20 years. When she finally needed cash for retirement in 2015, her original investment had multiplied 18 times. If she'd sold when it tripled, she would have given up 85% of her eventual gains. But there's one more element that makes this work. You need fuel. Rule number 4. Reinvest every dollar the business generates. Once Warren owned businesses he understood, bought at stupid prices and never sold, he made sure every dollar they generated got reinvested. Here's the 4th problem. People buy good investments and then siphon off the cash. They spend the dividends. They take distributions. They consume the seed corn. The businesses make money, but the money never compounds because it gets spent. Warren structured everything to reinvest. When See's Candies made $70 million in profit, that money didn't buy yachts. It bought more businesses. When Geco made billions in underwriting profit, it didn't go to executive bonuses, it went into stocks. Every dollar that came in got redeployed. Let me tell you about a business owner in Dallas. 1995. Built a software company, good business, by 2000, generating $3 million a year in profit. He owned 100%. Could have been set for life. But every year, he pulled out $2.5 million to fund his lifestyle. Big house, $12 million, exotic cars, private school, $120,000 a year, vacations. He was living the dream. The business stayed at $3 million in profit for 20 years. By 2020, still making $3 million a year. Hadn't grown because he never reinvested. He sold it in 2021 for $18 million, 25 years of work, plus the $50 million he'd pulled out. Total, $68 million. Good money. But here's what kills me. If he'd lived on $1 million a year and reinvested the other $2 million annually into growing the business, hiring better people, building better products, expanding, that business would have compounded at 12% annually. That $2 million per year reinvested would have built a business worth $240 million by 2020. He chose $68 million. He could have had $240 million. He consumed the seed corn. Compare that to a woman who built a janitorial services company in Cleveland, 1990. Started with 1 van and 3 employees. By 1995, making $200,000 a year. She could have pulled out $150,000 and lived well. She pulled out $40,000 per year, lived modestly. Reinvested the remaining $160,000 into hiring more people, buying more equipment, landing bigger contracts. By 2000, $600,000 profit. Still only took $60,000. By 2010, $2.8 million. By 2020, $7 million. She sold it in 2023 for $42 million plus. Over 30 years, she'd taken out maybe $2 million for living expenses. Total, $44 million. She made almost as much as the software guy who started with a much more valuable business. Why? She reinvested. He consumed. Here's the math Warren understands. A business earning $1 million per year for 30 years, with all profits consumed, generates $30 million total. That same business earning $1 million in year 1, with 80% of profits reinvested at 12%, generates $240 million by year 30. Same starting point. Different discipline about reinvestment. Warren has been reinvesting every dollar Berkshire generates for 60 years. That's why a $20 stock in 1965 is now worth $620,000. Not because the original business was worth that much, because every dollar the business generated got reinvested into buying more businesses, which generated more dollars, which got reinvested again. Most people cannot do this. They make money and immediately want to show it. Warren made money and immediately redeployed it. That's the difference between millions and billions. But even with all of this, there's one final rule that makes it all possible. Think about this for a second. How much of your investment gains have you spent instead of reinvested? Every dollar you spent buying things is a dollar that can't compound for the next 30 years. That's the cost most people never calculate. Rule number 5. Live below your means no matter what. The final thing Warren did that nobody else does, he never upgraded his lifestyle to match his wealth. Here's the fifth problem, and it destroys even disciplined investors. They make money, and they immediately inflate their lifestyle. Bigger house, better cars, more expensive everything. Then they need to make more money to support the lifestyle. Then they can't afford to be patient. They need returns now. Warren lives in the same house he bought in 1958 for $31,500. It's worth maybe $1.4 million today. He's worth $140 billion. He could buy a $100 million mansion. He doesn't. He drives a Cadillac, not a Bentley. He eats at McDonald's. His lifestyle has barely changed in 60 years. Here's why this matters. Because his lifestyle stayed modest. He never needed to take money out of investments. He never needed to sell Coca-Cola to buy a yacht. He never needed to cash out of American Express to upgrade his house. All of his capital stayed invested, compounding for 60 years. Let me tell you about a hedge fund manager, 1995. Brilliant guy. Started a fund with $10 million. By 2000, $150 million. He was making $8 million a year in fees. Should have been set. But he upgraded everything. $18 million penthouse in Manhattan. $15,000 a month in maintenance. $500,000 Ferrari. Clubs that cost $200,000 just to join. His annual expenses went from $80,000 to $2.5 million. Then 2008, his fund dropped 40%. Investors pulled money. By 2010, managing $25 million, his fees dropped to $1 million a year. His expenses were still $2.5 million. He had to sell his penthouse at a loss. Had to liquidate personal investments to cover bills. By 2015, he was working for someone else's fund, making $400,000 a year. He'd made $50 million over his career. He ended up with less than $2 million because he upgraded his lifestyle every time he made money. Compare that to a dentist in Omaha, made $220,000 a year for 30 years, never upgraded. Lived in a $180,000 house, drove a Honda Accord for 15 years. His wife drove a minivan for 18 years. They spent $90,000 a year. Invested $130,000 every single year for 30 years. Same house, same cars, same modest lifestyle. While everyone around them was upgrading to bigger houses and luxury cars, they just kept investing the gap. He retired in 2020 with $11.2 million. A dentist, making $2,000 to $20,000 a year, ended up with more than a hedge fund manager making $8 million a year because the dentist never upgraded his lifestyle and the hedge fund manager couldn't resist. Here's the math most people don't understand. $130,000 invested annually at 10% for 30 years becomes $11.3 million. That same $130,000, if you instead spend $100,000 of it each year upgrading your lifestyle and only invest $30,000, becomes $2.6 million. You gave up $8.7 million to look successful. Warren understood this. He watched his friends buy bigger houses, fancier cars, and private jets. He stayed in his modest house in Omaha. That discipline, that unwillingness to inflate his lifestyle, meant every dollar he made stayed invested for 60 years. I'll give you one more example that shows how powerful this is. Two brothers in Texas, 1985. Both became engineers at oil companies. Both made $75,000 a year starting out. By 2000, both were making $180,000 a year. Same career trajectory, same income. Brother one bought a $450,000 house in 1990, upgraded to a $780,000 house in 2000, drove BMWs, vacationed in Europe twice a year, country club membership, boat. His annual spending, $160,000. Brother two bought a $180,000 house in 1990, never moved, drove Toyotas, vacationed at national parks, no country club, no boat. His annual spending, $65,000. By 2020, when both retired, Brother one had $2.1 million saved. Brother two had $8.9 million. Same income for 35 years, different spending discipline. The gap, $6.8 million. Here's what's crazy. Brother one felt richer his entire life, lived in nicer houses, drove nicer cars, looked more successful, but brother two ended up with 4 times the wealth because he never upgraded. Most people cannot do this. They make money and immediately show it. Warren made money and immediately hid it back into investments. That's why he's worth $140 billion instead of $10 million. I learned this watching Warren for 60 years. Let me tell you about the first time I met him. 1959. He was 29 years old, running a small investment partnership, living in a modest house, driving an old car. Nothing impressive. I was already successful. I'd made good money as a lawyer. But watching Warren, I realized he had something different. He wasn't trying to look rich. He was trying to be rich. Those are not the same thing. I watched him say no to thousands of investments over the decades. I watched him sit in the same house while everyone else bought mansions. I watched him hold stocks for 40 years while everyone else was trading. I watched him reinvest every dollar while everyone else was spending. That's what made him different. Not intelligence, not access. Discipline. The discipline to do one thing consistently for 60 years while everyone else was jumping around chasing the next hot thing. Let me make this simple. Here are the rules. 1. Only swing at pitches you understand. If you can't explain the business to a 5-year-old, don't invest in it. 2. Only buy when the price is stupid. Finding good businesses is easy. Waiting for stupid prices is hard. 3. Never sell just because the price went up. Your best businesses should be held forever. That's where the real compounding happens. 4. Reinvest every dollar the business generates. Consuming the seed corn kills compounding. 5. Live below your means no matter what. The lifestyle inflation trap destroys more wealth than bad investments. These are not complicated rules, but almost nobody follows them because they're not easy. Saying no isn't easy when everyone else is getting rich. Waiting for stupid prices isn't easy when you want to invest now. Holding forever isn't easy when your stock triples and you want to take profits. Reinvesting isn't easy when you want to enjoy your money. Living modestly isn't easy when you can afford luxury. But that is exactly why these rules work. Because most people cannot follow them. Here's your challenge. Start doing what Warren did. Pick one business you completely understand. Wait for a stupid price, and that might mean waiting years. When you buy it, don't sell just because it doubled. Reinvest everything it generates. And for the love of God, don't upgrade your lifestyle every time you make money. I'm 99 years old. I have maybe a year left, maybe less. I'm telling you this because I won't be here much longer to tell you, and I don't want you to waste your life chasing complexity that doesn't exist. The formula is right here. Understand, wait for stupid prices, hold forever, reinvest everything, live modestly. That is it. Follow those rules and you will build wealth. Ignore them and you will watch other people build wealth while you stay busy. Your choice. Now, if you want more brutal honesty about investing, timeless principles that actually work instead of get-rich-quick garbage, subscribe to this channel. We don't promise easy. We don't promise fast. We promise truth.